We have Dan Erb with me here today, and he's going to be with Strand Capital LLC. And you're going to find those as clickable links in the show notes. It's Strand Capital LLC. But Dan will be looking for you to reach out directly to him on LinkedIn. And I'm going to have that link as a clickable one in the show notes as well. Really appreciate your time here, Dan.
Yeah, thank you, Jack. Appreciate you having me on.
We're going to be focusing on single family houses as rental property here today. This is going to be interesting because we haven't found a lot of people going to the level that you have and your team has regarding accumulating single family homes as rental property. And so, Dan, before we jump into that, could you start things off by spending just a couple minutes talking about how you found your way into real estate investing? Before this, it sounded like you were in banking or financial services.
Yeah, so I was a first year analyst working for a middle market investment bank in Chicago called Brown Gibbons Lang. And like most investment bankers, I was working a lot. What I found addictive almost was moving up on the learning curve in that job because it's very steep. And so I was pushing for weekend work. I was spending a lot of late nights in the office and I was able to expense a lot of meals as well. And so by the end of that first year, I had saved up a ton of money from my salary. And then as well, I got this big bonus and, I wanted to deploy it somewhere. I called up my cousin, who at the time was working on Wall Street and he was there for 10 years plus. We talked about different areas we can invest in and we both decided on real estate.
Before we hit record, you were talking about how you find these single family homes. Could you talk a little bit what is your buy box and include like the part of the country that you typically focus on?
Yeah. So if you think about it from the top of the funnel, single family, there's over 130 million houses in the US, and only about a third of those are rental property. And then you combine that with the demographics in the US and people that are my age wanting to live in single family homes. And between the two of us, my cousin and I, we put our heads together and we just saw a huge opportunity. So yeah, there's not a lot of institutions playing in this space, limiting our competition, and people tend to buy single family homes with emotion. And by being more thoughtful and astute, it was a way for us to be differentiated than the other buyers on the market. So we started with MLS searches. However, what we found was that it was really tough to sit in Chicago and New York City and say where someone in Indianapolis would want to rent at. The reason why we picked a market like Indianapolis to start out was because we were able to cash flow more, something that higher cap rate markets have versus Chicago and New York. So that was the first way we filtered, what would be our annual income if we were to rent it out. The second way we filtered down was which of these properties are most attractive to the people that live there and are real estate professionals, meaning their day to day job is walking, talking with tenants, talking to potential buyers, and selling properties. And once we added those brokers into the mix in terms of filtering the best properties, we start punching in our assumptions into Excel, and we were able to find some desirable investments even on MLS. And we further leaned into this local real estate professional strategy where instead of working against them or finding ways to cut commissions or save a few dollars up front as a buyer, we wanted to partner with these folks. So we said, we want to work with you as our property managers. And at the end, you can get the exclusive right to the listing. And since taking on that strategy, finding desirable investments hasn't been as much of a challenge as it's been to other real estate investors.
Okay. So you've mentioned you're relying heavily on those local professionals. Where are you typically buying the house? You already mentioned Indianapolis. Is that where your focus market is?
So Indianapolis, we have the majority of our properties, and we have also expanded into Chattanooga, Tennessee, and Birmingham, Alabama.
Okay. So when you say local professionals, are you talking primarily property managers or are you talking about realtors?
These are realtors that either make a property management business to work with us, or they are realtors that also do property management. And this is very common across the country. A lot of property managers, even in Indiana, for example, you need to be a licensed broker in order to service property.
Sure. Always seen that more and more often where you do need to have those type of licensing. So, with all of that, then, could you talk a little bit more in depth regarding the type of property you're looking for? We've had a little experience in Indianapolis market, and I would imagine that you're not playing in the low income or that type of market, but maybe you are.
So we like to look in the Class A, Class B neighborhoods within these respective cities. And so we work hand in hand with the brokers to develop a heat map of sorts that looks at unemployment, that looks at median household income, median home price. And you could do that from publicly listed information in the census. When you work with the broker, it's about within each county, okay, you don't want to go south of this highway. You want to primarily stay north or you want to stay west. And so we're able to slice it pretty granular. In terms of the types of properties we're buying 3 2s, 3 1s, but we'll also look at 4 bedroom, 5 bedroom houses or 2 bedroom houses if these are off market or almost opportunistic type investments. But primarily, or all of our properties are in what I would consider Class B, Class A neighborhoods. However, what we buy at, I would say, is more reflective of probably what you would see when you're talking about Section 8 or affordable housing.
Okay. So, with that, with Class A and B property, a lot of people are going to be familiar with the 1% rule. What type of returns are you trying to achieve buying Class A and B properties? The rent prices on some of these regarding the purchase price must be fairly comparable there.
So the 1% rule, which is right, you want monthly rent, that's 1% of the purchase price.
Right.
We've achieved that on probably about 50% of our properties. The way that we're able to buy at such an attractive price is through a combination of patience and these partnerships. And what I mean by patience is I can tell two stories. The first of which is a home we most recently bought, which we bid on 7 months prior, got under contract, and the deal fell apart during the inspection. That seller sat on market for 5 more months, received no bids. And then we were able to come down at a significantly lower price. And so that's what I mean by being patient. Oh, buying at the very lowest price possible. It's about buying where the numbers make sense, especially given today's debt markets. And so from our end, it worked out really well because we were able to take advantage of an opportunity that if we weren't as patient, we wouldn't have been able to achieve. Or another example is someone listed their property at the top end of the market. And this was back in 2021 when everything was being bid above appraisal or being waived inspections. And because they listed at the top end of the market, they didn't receive bids. And after 3 weeks of 21 days, we were able to bid at a 15% reduction to their list price. And they accepted because 21 days at that time was almost an unheard of amount of time to stay on market.
So you said about half of the properties that you buy hit that 1% rule. When you're talking about, I think a lot of people who are looking for this type of thing, this is going to be somewhat new to them because we're looking for distressed property where we can add value and there's going to be like the Burr strategy, that type of thing going on. You're talking about class A and B properties. I'm guessing they're newer construction and they're probably not going to need as much repairs. Is that fair to say?
That is fair to say. I think consistently we've seen houses with deferred maintenance. Yeah, we need to repaint a wall, change the front door, maybe patch up the roof a little bit, but no, we have not done a complete turnaround project. And that's something we would try to avoid if any.
Okay. So those boots on the ground that you have in these different cities, are they? that's who are going to be doing any kind of updates and repairs as you close on these properties?
So we work with general contractors, or we almost serve as a general contractor where we'll sub certain parts of the project. It is definitely important that our three partners are able to walk the properties, take videos, and provide suggestions, especially before we get an inspection, because we don't want to go under contract. And then it's a combination of us training folks in terms of what sort of information we want to pull out when you first walk a property. But in terms of the types of repairs that we're doing, or the types of repairs where we've seen the best return for our investment, it's been the lighter touch, high IRR type things that you would think of: repainting, hardwood flooring, stuff like that.
Sure. So every property that you acquire, all three of you walk it?
All No, I do not walk the properties, but I don't walk the properties until close to close. My cousin, he stayed in New York for the most part. I would say he's more the quant side versus the operational.
Sure. Okay. So I'd be curious, you've moved into 3 different markets here now. How has that networking occurred? Like, how have you been finding those people that and companies to partner with to get this done?
Yeah. So I think that really it's about selecting the right markets, and then spending time in those markets yourself. So to start, we spend a ton of time getting to know the market before we even decide to go and visit ourselves. And so what I mean by that is we do bottom up research basically across the country in terms of what we expect demand for single family housing to be. And then as well, we compare that to housing starts, which is all public information. If we don't think that the market is undersupplied, or there isn't a gap between forecasted demand and housing starts, we won't spend much more time in that market. Then our second criteria, which helped us really focus, is where can we cash flow in the current rate environment? So we want a strategy that works regardless of what's going on with interest rate. And by buying in markets with a market cap rate above the 10-year treasury, or what you would get on a 30-year fixed mortgage, it's a way to protect our downside. But primarily, it's a ton of research heading in, and that involves also calling brokers that you can find on Zillow, you can find on Redfin, or a myriad of sources, and talk to them about the types of properties that they see. Talk about, have they worked with investors before? Have they ever managed a property before? How would they like to work with investors that are looking to move volume? And yeah, once we built our track record in Indy, it was really easy to show people what we've done. When we gain a lot of confidence in the market, I said the second part of that is spending time there. And I personally have lived in each one of these cities for over a month. And so I've gotten to know the markets. I've gone to spend time with these professionals. I've gone to walk properties with them, even places that we weren't necessarily interested in bidding on, but just to understand their process and how they work. And by the time we select someone and start investing money, we have a high degree of confidence that we can exit.
Sure. Just to remind everybody, we're talking to Dan Erb over at Strand Capital LLC. You could learn more by those clickable links in the show notes. And if you found some value in what we're talking about so far here, do us a quick favor and share this with one of your real estate investing friends. And if you're watching us on YouTube or Rumble, do us a quick favor and doing like and subscribe. You can also find Dan on his LinkedIn page, and I'm going to have that as a clickable link on the show notes if you want to reach out directly. So, Dan, you mentioned now that you run these numbers on an Excel spreadsheet and you want make sure all of these properties cash flow. Is there a kind of a minimum you'll consider? Is that a dollar amount or a percentage? What is that cash flow amount that you're looking for?
Yeah. So we want 200 basis points above our cost of debt. And by cost of debt, I really mean interest rate. And so I think a lot of people underwrite properties in terms of what their monthly payment is versus what their monthly cash flow is. And we obviously do the same, but we look at the three kind of metrics, which is what is our cash on cash return before amortization payments and before capex. Then what is our cash on cash return before amortization payment. And then lastly, what's our cash on cash return, or what is our fully levered cash on cash return, which is post interest expense, post amortization payment. And that last metric, which is important, we don't necessarily care if that's 5% or 6% or 7%. It needs to be positive. It needs to be, call it around 5%. Those other two numbers are cash on cash before capex, which is almost like an adjusted EBITDA if you're thinking the finance markets, or a stabilized yield. Our cash on cash before amortization payments, which is what's our return before we start paying off our principal and building equity. Those also matter a lot.
200 basis points, that definitely does make sense. So you said, is this the 200 basis points? Just to clarify, is that after your CapEx and all the other expenses, or is it just based on the debt you're carrying?
So if we can take out a loan of 7%, we want a going in cap rate of 9%.
Sure. Yep. So when you go into a new market, let's say you got all of these markets and somebody is going to do this for the first time themselves. How did you select the property managers that you're in these markets, and what type of questions did you ask them?
So the first time around, it went really poorly. And I think a lot of people run into this, especially as an out of state real estate investor, which is you just work with this broker for the past few months. They were fantastic. You had a great experience. You feel really confident about your property. And then you get to your property manager and they suggest something totally different. You think you're going to get this property leased out in 30 days. You think your repairs are going to be done in 15, and that timeline starts extending. And I came from a world of private equity healthcare where, private equity companies were running into a similar problem with physicians, which is how do we get them to care after we buy their business, after we write them a big check for when we eventually go and sell the platform. And the way they did this was through aligning incentives. And there's a number of different ways to skin that cat, which is you could give equity bonuses, milestone payments. You could give very robust non-competes, non-solicits. Now, a lot of that has gone away. I think from my end, I was, how do I apply that to single family real estate? And it really was making sure that they understood that if they managed the properly thoroughly for the 5 years, if they gave us the right assumptions up front and proved that they were capable of doing it, we could invest more money and they would get this second bite of the apple at the time when we sell the property, because we are investors and we want to liquidate, we want to refresh our portfolio eventually. And we got a lot of buy-in from them. I think in general, property management is a sweat game. It's a high effort, low pay kind of volume play if you're going into that business, or low margin, I should say. Since undertaking this model where we were working with them for the full investment horizon, I'd say it relieved a lot of stress from that first go around where we weren't getting showings done at the urgency that we needed to. We were getting way too aggressive of first month rent for that market or for that unit. And then we had someone we had to teach about the property or spin them up on the property and why we were so motivated to close on it. And so what I would suggest for folks that are doing this is make sure you spend a lot of time with your property manager. Make sure you get to know them, make sure that you talk to their existing clients, make sure that you have confidence that if you text or call, or a tenant is texting or calling, that someone's going to be on that other line, because it is a very high effort job. And so you want the right person in that seat.
Yeah, one of the biggest things that we've consistently found is just having the interests aligned. If you can find that's the magic bullet there.
I think that's where not coming from traditional real estate was a huge advantage for me because I did feel like I could look at this from a brand new perspective and take what I learned in a completely different industry. And I think that's what's allowed us to really grow over the last few years when a lot of people were on the sideline.
Yeah, I was going to ask you, like, what other things did you learn from the previous role in the financial world that you brought to the real estate world?
I obviously learned how to use Excel and learned how to use PowerPoint. And those are really helpful tools. It's something that I still use a lot in doing this real estate job. And so knowing how to model, knowing accounting, knowing how to present or create a clear presentation, that has definitely applied to this role or the change in roles. I think more on the soft skill side, though, it was the greatest benefit. So just being surrounded by some of the smartest people that I ever met from such a young age and having access to those individuals and hearing their stories. So I worked at a bank where our bread and butter were founders. Those were our clients, people that built these 8 to 10 figure businesses themselves. And we would go and we would sell their baby or we would sell their business. And so sell side M&A was, I lived, breathed, slept it for 2.5 years. And you learn so much about that founder, where their strategy is, what their edge or differentiation is, and how they leaned into that, and how they grew something from zero to 50 million in revenue or above. And so I think just being able to absorb that and be around it for 2.5 years where I was working 80 to 100 hours a week is just something that's incredibly invaluable. Not necessarily a brag, but if you read Malcolm Gladwell's Outliers, I am a master in both Excel and PowerPoint. It's not something I'm going to talk about on my deathbed, but put in the work. And now I actually teach it. And it's something that's allowed me to really be smart about this real estate company and build it the right way, not necessarily in a way where, I'm making as much money as possible. And so those skills just are so desired that there's a whole industry out there for training in Excel, training in PowerPoint, training in investment banking, soft skills, and things like that.
So you excel at Excel. Oh, it's a dad joke. I was sitting on it there for a few seconds. So you said you have them manage the properties for 5 years. Is that your exit strategy? You hold them for 5 years at a time, or how does that work?
So we actually look at it at a year over year thing or a turnover, I would say. And so what's a huge advantage about single family versus family or apartment builds is that single family tenants tend to stay for 2 to 3 years versus the 12-month turnover. When you
Mm,
combine that with the areas that we're buying in, which is, class A, class B, those tenants tend to stay, closer to 3, 4 years. And so every time that we have a tenant leave, we assess the current rental market versus what the returns would be if we sold. So we will sell before 5 years, but I think in terms of getting or aligning incentives, we tend to, or we have it in our contracts where it's, you don't get full credit for that listing when we end up selling if you don't manage the property for 60 months
sure.
or lease the property for 60 months.
Okay.
Okay.
What is the end goal for Strand Capital then? What are you guys shooting for?
Yeah, I think that if we can continuously be very smart, but at a greater scale, And what I mean by that is I envision us being throughout the country and continuing to be really nimble in terms of the markets we go into, when we go into them, and when we eventually exit them. We don't have a crystal ball. I wouldn't act like I do, but all assets go through cycles, and I think what single family is going through right now, it's a great time to be a buyer. I don't know if everyone's thinking like that, and so the fact that I think my viewpoint's a little contrarian, but yet I have a ton of data and numbers to back it up, brings me a ton of confidence. So in 5 to 10 years, I want to be throughout the country. I hope that interest rates come down here and settle down because that opens up a lot of new markets to us as well. And maybe even beyond that, we start at different asset classes and different industries. And as long as we stick to our investment thesis or our pillars, which is finding assets during the right cycle, making sure that there's something like the supply deficit in single family that brings us confidence on downside, and then penciling every single deal, having that high attention to detail that I obviously learned when I was building PowerPoints, pitch decks, Sims, things of that nature. I think all those things have really helped us so far, and we can continue to do that. And I think the sky's the limit in terms of how far Strand can go.
Dan, this has been a fantastic conversation. I really appreciate you bringing so much value. Before we switch into the rapid fire questions, is there a question or concept you wish we would have covered so far?
Yeah, so I do want to talk a little bit about Strand Capital or a little bit more because I've been marketing EM Capital, which is my prior business for a really long time. And what I think is so exciting about Strand Capital in particular is this third partner that is coming on board and the experience that he brings and complements the current team, which is myself, investment banking, private equity type background, knowing how to structure, how to make these deals and align incentives. My cousin, who's a veteran on Wall Street and has been doing equity research for companies like BlackRock and T. Rowe Price for 10 plus years. And the level of depth and breadth of research and data analytics that he brings to the table, I think really differentiates us in terms of the markets and assets that we're selecting. And then lastly, the third partner, Rajan Bhatt, who founded Spectrum Dermatology, has also worked on a number of real estate deals for the past 2 decades. And the operational experience and marketing experience that he brings to the table, I think these three pillars between the three of us, yeah, it is very exciting. And so it's not that EM Capital isn't something that I was excited about, or it's not that I'm changing my investment thesis. It's just this new opportunity, I think, for our existing and any new investors has a lot more upside and a lot more potential behind it. And so I'm really excited to get this off the ground.
Yeah, it sounds like a really exciting opportunity. Again, it's Strand Capital LLC. That's going to be a clickable link in the show notes, as well as Dan's direct LinkedIn page. So you can directly message him if that's something you're interested in and how you could maybe work together. Again, it's Strand Capital LLC. If you're ready, Dan, we'll jump into some rapid fire questions.
Yeah, go for it.
First, what lie do real estate investors tell themselves and sometimes to others?
That a 4% cap rate appreciation play is a guaranteed return.
That is a good one because it's not always the case, is it? If you could go back in time and give your younger self one piece of advice, what would that be?
Listen more than you talk.
That's especially a good one. I actually, that's something that my parents used to tell me.
Yeah, I should have listened to mine.
There's a lot of things that, in hindsight, your parents probably knew a lot more than you gave them credit at when you were a teenager. What single strategy, process, or tool have you implemented that has had the biggest time saving impact to you and your business?
I think for content writing, editing, that having a kind of second set of eyes for things, especially as someone that for the most part was working in isolation. It's been a huge time saver for me. You definitely need to go back and double check some stuff, but I think put things like ChatGPT, they're going to be here for a while, and being an early adopter of it's definitely saved me a number of hours.
What book would you recommend or what are you reading right now?
Book I would recommend to folks, Straight Shooter by Stephen A. Smith, but you need to listen to the audiobook. It's not the same reading it. Um, just going through his life, what inspired him, how he became a master of sports journalism and his background to getting there. It was all very inspirational. And then as well, just for someone I listened to a bunch as a kid, just seeing, being able to look under the hood was really cool.
Dan, this was fantastic. Again, it is Capital LLC. That's going to be a clickable link in the show notes. But I hope you'll come back again, Dan. It'd be great to catch up here in the near future to see how new partnership is ironing out.
Yeah, would love to come back. It was a great time. Great conversation too.